Hey guys, good afternoon everyone. I'm Harshad from Kepler Capital. Welcome back to our YouTube channel. Welcome back to our YouTube video as well. Um, as you know, as you are aware for sure that we have started all about price action series, and obviously we have published part one of the series last week, and therefore I am here to bring the part two of the same series all about price action. So as I've mentioned hundred and thousands of times that price action is extremely important if you want to sustain in the short term, mid term, long term in the stock market. And the reason for this is understanding the psychology mindset of retail traders, big players, F2s, D2s, and everything as in general. So stock price action is very important for a professional trader or a beginner trader who is aspiring to be a professional trader in the near future. So let's begin with today's session. In the last video, I guess so we have ended up till 1 second. I'm sorry. Yeah, 1 second. Yeah. So in last session, we have basically seen the basics of market structure, like sideways, uptrend, downtrend, consolidation, accumulation, distribution, etc. We are going to continue the series over here. You see, price action is a very deep subject, right? Can't be learned in a day or two or something like that. Because until and unless you don't practice, you don't read the price action on the charts, I don't think it's so you will master the price action theory. So let's begin with the first topic. What is impulsive move and corrective move? See, impulsive move is nothing but when the price is when the price is in a trend. Let's say the price is in an uptrend. So the impulsive move will be the bullish move, and the corrective move will be the bearish move. So corrective move is also known as the retracement or the pullback, where markets tend to go higher slightly, then create a new low, then create a new higher high, unlike like this. This is the impulsive move. This is the corrective move in the uptrend. Impulse, impulse, correction, and that's all. Similarly, in the downtrend, this is the impulsive move, corrective move, impulsive move, corrective move, impulsive, correction, pullback, retracement, whatever we can call, and again, impulsive move. So, I hope this is clear, the difference between impulsive move and corrective move. End of an downtrend. So, how do you realize that? Let's say market or price was in an uptrend for let's say 10 to 12 days, then how you as a trader, how do you figure out, like, okay, market was in a downtrend, sorry, in an uptrend since last 10 to 12 days. Now things seems to be changed, so therefore maybe there is a probability that market will go downward or reverse from here. So how can we figure this out? It's very simple. You can see over here, this is the register, so this is the support line, correct? And this is the consolidation. This market consolidated over here. Obviously, traders build their position, especially the big players. Then market went up, created new high, new low, new high, higher high, higher high. You see, higher high, higher high, higher high, and higher high. No, so this is an indication. If market fails to create a new higher high in an uptrend, then this is a clear indication that market will reverse from here. See, market didn't created a new higher high, unlike like this 1, 2, 3, 4. It basically break the what do you call the trend line. So therefore, this is a clear indication that buyers have basically buyers have stopped buying or sellers have basically overpowered the buyers. So therefore, we can see a trend reversal from here. Now, trend reversal don't happen suddenly like a panic. It basically happens after a consolidation. Like for let's say, it depends actually what the time frames you see the charts in, but obviously trend reversal happens in a kind of consolidation. It may be like M pattern, it may be head and shoulder, or maybe it can be normal consolidation, like flag or pole pattern or something like that. So this is the indication of price reversal. Moving ahead, end of downtrend. Similarly, now how to figure out downtrend is going to end. Similarly, like an uptrend, if market or price does not create a new lower low over here, see, lower low, lower low, lower low, lower low. No, market have break the what do you call trend line over here. So this is an indication that market will end the trend over here. We can see in the live charts as well. That's not a big deal. This is Nifty. This is 1 day time frame. See, as a beginner trader, make sure you see the charts, you observe the charts on a daily time frame in order to get a bigger picture, because many a times the probability of price action candlestick pattern failing on a smaller time frame like 1 minute, 5 minutes, 15 minutes is higher than things failing in on a daily time frame. So you see, downtrend ka example, let's see. This is a trend line. Okay. Market was in clearly in a downtrend. How do you figure out a downtrend? Super simple. You go over here, higher low stuff, higher low stuff, four higher low stuff. Now the market didn't create a higher low. In fact, market basically created a W pattern and then bounced back. So this is an indication. This is the indication. In fact, this is the indication. So therefore, it's important to draw. What do you call rectangle stuff and all of that. This is the indication where market then created a new higher low. Therefore, this is a sign of prices getting reversed. Similarly, in the uptrend as well, price was in a uptrend over here, kind of uptrend. All right. How do you figure out the uptrend now? Higher high, higher high. See the prices is taking support from the resistance. Oh, sorry, trend line. Higher high, higher high, higher high also, but higher high no. So therefore, it's a sign of reversal from here. Super simple stuff, man. Price action is so super simple. Indicators are bullshit. Very important concept. Candles. Candlestick is nothing but, let's say, what is candle? Let's say candle indicates the price of an financial instrument in simple layman's language. So let's say the candle is green, then obviously it's a bullish candle, means bulls are in power, and if the candle is green, then obviously it's a bearish candle, means sellers or bears are in power. So this is the basic structure of a candlestick. In terms of bullish candlestick, this is the open. It opens since buyers are in power. Buyers bring the prices upwards. Therefore, this can be close, high, and low. Low indicates that sellers were active over here, so therefore they attempted to bring the prices down, but unfortunately, buyers didn't, allow them to take the prices down. Similarly, bearish candlestick pattern. This was the open. Sellers were in control. Prices came down till over here. This was the low, and this was the high, meaning buyers tried to bring the prices till here, but unfortunately, since buyers were in control, they closed the price over here. So this is the basic concept or the basic structure of a candlestick. You have to, you know, be love. You have to be, you have to fall in love with candlestick, price action, different kinds of patterns, then buyers, sellers, psychology, mindset, etc. Until and unless you can't be a successful trader, that's for sure. The next bullish Marubozu. First candlestick pattern is bullish Marubozu. Very simple. Bullish Marubozu in the sense power candle. There is no such thing as wick, no upper wick, no lower wick, nothing. Candle is completely green, completely power candle. It's a reversal candle. Let's say market is in a downtrend. If a Marubozu happens, then it's an indication that buyers is extremely powerful and the trend will be reversed over here. Probability of the trend reversing is much more higher. Simple. Similarly, bearish Marubozu, red candle with no upper and lower wick at all occurs after the end of the what do you call it, uptrend. Clear indication that sellers are in power because there is no wick. Then obviously there are no buyers active in that specific candle. So therefore, it's a clear indication that sellers have overpowered the buyers at that point in time, and therefore there is a high probability that prices will fall down or market will fall down. Simple. Hammer. Hammer is also a reversal candlestick pattern. Hammer occurs after a downtrend. Market was in a downtrend and hammer occurs. So there is a high probability market will reverse from here. What is the psychology behind hammer candles? See, hammer candles wick is extremely large as compared to body. Like body is only 30% and wick is 70%. So this is an indication that sellers tried to bring the prices till here, the wick. But buyers were so active. Buyers overpowered sellers in this specific candle that a hammer is created, and therefore there is a high chance the market will go up over here or price will go up over here. Hanging man. Hanging man is nothing but the reversal of hammer. Hammer occurs in the I mean before the uptrend, wherein the hanging man occurs after after a uptrend when the downtrend is going to begin. Simple. Inverted hammer. The concept of inverted hammer is similar to the hammer. The only difference is hammer is inverted, means pick is on the upper side and body 30% body is on the lower side. Shooting star ka concept is also similar to bearish hammer, but the concept over here is big is on the upper side and body is on the downside or lower side. It occurs after an uptrend or after a rally, and it if the shooting star occurs, then obviously market will fall or prices will fall. Spinning top. Spinning top is basically I can say neutral candle where buyers and sellers are basically confused, like they are not sure if the market or if the prices will go higher from here or lower from here. So therefore, buyers and sellers are both in control, but 50-50%. Doji. Doji is again a confusing candle or indecision candle, but only the difference between what do you call doji and spinning top is that doji candles indicates that there will be a sharp move from here. This move can be either up on the downside or on the upside. The reason for this is because I mean buyers and sellers are so confused or indecisive that they are not able to figure out whether the market will go up from here or whether the market go will go down from here. So these were the basic concepts of what do you call candlestick patterns, and what we have seen before candlestick patterns was yeah, uptrend, downtrend, end of the downtrend, etc. So this was today's session, part two, all about price action, and let's catch you up at the part three series, which will obviously be on every weekend. And that's all from my side today. Thanks for watching. Do subscribe, like, share this channel with your peers, with your friends, traders, investors, whatever, and make sure to um, watch this full video of all about price action part 1 in order to understand the today's video, which is obviously part 2. Thank you so much.